Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by Bull Realty. For any commercial real estate needs in the Southeast U.S., please reach out to me directly. My email is michael@bullrealty.com. Well, we have a fantastic show for you today. We're going to talk about the 2023 outlook for the economy, commercial real estate, and REITs. We have a report here that's put out by Nareit every year. They do a good job at looking at the economy, looking at commercial real estate performance, and then REIT performance moving forward. Please welcome my guest. It's Ed Pierzak. He's Senior Vice President of Research with Nareit. Ed, thanks for joining us, sir.
Thank you, Michael. Pleasure to be here.
And first, I'd like to start with, I guess, the elephant in the room, some people might refer to it as, and that is the recession risk. At this point, here we are, close to the end of January here of 2023. What's the outlook on the R word?
Well, that's really been kind of the hot topic. So if we look back on 2022, we really saw that the U.S. economy had quite a few headwinds. So we had mixed economic growth results, waning job gains, elevated inflation, and rising interest rates. And even if we took a look at worker confidence, we saw that was falling off a bit when we take a look at the quits rate. But when we take, really just a closer look at the risk of recession, we could kind of look at the Bloomberg Consensus Survey. And you see we started 2022 at about 15%. Ended the year at 70%. So clearly it's something that's on everyone's mind. And as we look at 2023, that's the big worry.
Right. And I guess there's different views of how bad it might be or how deep and long, right?
Yeah, it's really kind of difficult to say. But, when we take a look also at just kind of REITs, where they're positioned today, we really feel that they're in a great position to kind of go forward. There's a number of things that you could kind of look at, but, generally speaking, if we take a look at their operational performance and balance sheets, we have some aggregate data from Nareit's T-Tracker. And if we look through the third quarter of 2022, we see operational performance. It's really been pretty good. It's been resilient. Through that quarter, we had aggregate quarterly FFO hit an all-time high, just under $20 billion, just about a 15% increase from over a year ago. But also interestingly, when we take a look at NOI, we had about an 8% increase, same store NOI, 7% increase. So really all this data just underscores that REITs have been keeping pace with inflation. But, I think the other part of this is when we think recession, we really see that, REIT balance sheets, they're in great shape. I think that REITs have been very mindful of their experiences through the great financial crisis. And when we take a look at leverage ratios, they're near historical lows. We look at the amount or proportion of fixed rate debt they have, over 80%, weighted average term to maturity at about 7 years. And then we also even see the weighted average cost of that debt at about 3.6%. So again, just in a good position to weather whatever 2023 has in store.
Yeah, and that's interesting to look at because this sudden increase in interest rates certainly has slowed down some transaction volume. It's impacting property values out there, right? But the REITs, I guess, are in a pretty good position, but I guess it will impact the values. But if they're not selling them, at the moment, I guess it doesn't matter, right?
Yeah, so I guess kind of a few things to maybe note there. You kind of, mentioned kind of interest rates going up. And, although I think that, REITs have a, pretty low average cost of debt, it's important to note that they're not immune. So, we probably saw the 10-year Treasury, really just kind of surge in 2022. And even with that very large increase over the course of the year, we've seen that that weighted average cost of debt for REITs only went up about 30 basis points. So there is going to be some movement there. But I think one of the other factors, you kind of talked a little bit about valuations. And when we look at 2022, I think that it was really kind of a time for divergence. And we see that in REITs themselves, operational performance really pretty solid. However, valuations are down. So I think, they ended the year at about 25% down on a total return basis. But also we saw this divergence in a comparison of we would call it cap rates, so the implied cap rate on REITs and the private market cap rates. And we again see that there's been kind of a pretty solid movement. So when we talk about that surge in treasury yields, we see that REITs have been really pretty responsive to that move. And in fact, we end up seeing that I think that 10-year treasuries went up by, I think, over about 230 basis points through the third quarter. The implied cap rate on REITs went up almost by 160 basis points. And then lastly, when we look at the private market, it was just a little less responsive at a little under 70. And so we really kind of see this pretty sizable cap rate gap between the public and private markets. And so at about 120 basis points, all else equal, if private cap rates end up adjusting, you can see that this difference would suggest a potential 20% or more price decline. But I think it's important to note that typically all else is not equal. And as we look out into 2023, it's likely we'll see some movement in valuations from both REITs and the private market side.
Yeah, it has to happen, right, with the cost of funds. And I have a brokerage firm, regional firm in the Southeast, and we're certainly seeing it in the underwriting and closings that we've been doing recently in deals that we're working on. And one of the other things that is concerning everyone these days is inflation. What do you think the impact there is on commercial real estate and REITs? And then what do you expect for inflation in 2023?
So, I think that it'll likely continue to be an issue. I see that, we've had some tempering and some excitement over the tempering, but, really kind of inflation remains high. And, I think the good news is that, at least historically, real estate has been a pretty good inflation hedge. And again, when we take a look at our T-Tracker data and we look at our NOI growth numbers, we really see that REITs have been able to keep up with the pace of inflation. And we expect that to continue in 2023.
Yeah, it's interesting. We just were dealing with a large tenant on a single tenant building yesterday where, they say, well, if you guys don't lower our rent, we're going to have someone build us a new building. But, with the inflation, the cost to build that building is such that the rent really would probably be higher. So it's interesting what inflation does for values of existing properties, and how that might impact REITs.
Yeah, and as you mentioned before, you talked about the interest rate environment and really, higher interest rates and debt costs. It's really throttling, a lot of the transaction volume. I guess the silver lining in that is that new development is also being curtailed.
Right. One of the property types that obviously has been the most hit through the pandemic is the office sector. What do you say about the office sector and REITs moving forward?
So, I think typically, we don't talk too much, sector-wise, but, generally speaking, when we take a look at offices, I think that, ultimately this is really just a huge natural experiment, right? Where we're really having to kind of wait and see the impacts of work from home as well as hybrid working. And I think that's ultimately going to kind of determine the future of office.
Yeah, I get to talk to office owners and asset managers every day selling office buildings on a team I lead, and I think in my personal view is that we'll have a continued decline in demand for the next couple of years, and then I think the office market really turns around as this new supply wanes and companies start realizing, more and more companies realize the the impact on their employees and on their profits of having everyone everywhere trying to work. But yeah, we shall see there. Well, what else? One of the other things that I saw in your report that I thought was interesting is the historic performance of REITs in past downturns. Tell us about that.
Yeah, so definitely, when we talk about kind of recession going forward, a lot of people ultimately, they get pretty nervous about real estate performance. And I think one of the really kind of key elements that we have to kind of keep in mind is that a recession does not have to equate to negative property total returns. And and I think we could look at this in really kind of a few different ways. So, historically, average annual real estate total returns they've tended to be higher in stronger economic climates. So there's really kind of no surprise there. But if you were to take a look at annual real estate performance and really kind of break it down into three buckets, kind of a low, mid, and high real GDP category. And really all you got to do there is you kind of break things out into quartiles, with the low being the first quartile, the high being the fourth, and the mid kind of carrying the second and the third. And if you do that, you really see that real estate has performed well across economic environments. So whether it's a low real GDP or a high real GDP. And so even as we take a look at both the public and private side, we see that on average, real estate's posted positive returns across all the real GDP cohorts. We see that REITs have outperformed their private market counterparts in each of the groupings. And I think one of the most kind of compelling things is that we've seen that REIT outperformance was the strongest in the low real GDP bucket. And so, if we kind of take that just a step forward and we ask a little bit of the why behind that. And, we talk about this kind of lead lag relationship with public and private real estate, with the public side really leading by 6 to 18 months. And so if we take a look at the last 6 US recessions, what we end up seeing is that on average, REITs underperformed private real estate in the 4 quarters before a recession. However, REITs outperformed both during and in the 4 quarters after a recession. And then, just as a comparison across kind of broader equity markets and doing a comparison, say, to the Russell 1000 index, we really see that REITs outperform broader equities before, during, and after a recession. So, traditionally, REITs have really been well positioned to take advantage of economic recoveries.
Yeah, and it makes sense. It seems like the REITs typically have the higher class assets, which seems like a lot of folks are going to these days. If you just look at office, for example, the nicer Class A, newer buildings are seem to be doing better. And then if you do expect, if a listener, a viewer expects a recession and expects the market to recover after the recession, how are REITs positioned there compared to the private market?
Yeah, well, I think that, when we take a look at 2023, I think that, there's, really kind of different opportunities for REITs. One, I think, is a tactical opportunity, and another is strategic. And on the tactical side, again, when we take a look at 2022 performance, total returns down about 25%. We see that we've had an adjustment in cap rates. And we see good operating performance, solid balance sheets. So, as we look at 2023, particularly if there's a challenging environment on the horizon, we really see a buying opportunity. So I think that's one side of it. But then there's another side too. And, I think that it's really kind of REITs becoming, really part of what I would call a completion portfolio. And it's really kind of marrying the private real estate market and the public real estate market. And the reason some folks may want to do that is that when you even take a look at REITs, going back to, say, 2000 to today, there's really been kind of a maturity and transformation in the number of property sectors. And today, you really have 10 different property sectors. You've had really kind of a growth in some of what we would call kind of the modern sectors. We have data centers, cell phone towers, healthcare, cold storage, and then even industrial. When you take a look at what it was to what it is today, it's kind of gone from sleepy warehouses and manufacturing really to logistics centers. So REITs really offer the potential for sector diversification. I think that they could provide pretty easy access to a pretty wide menu of property sectors. In addition to that, you have the ability to diversify geographically, and that's not only here within the States, but if you had a global mandate, you could do that as well. And then lastly, I think that if you were really interested in pursuing some ESG strategies, I think that REITs have really embraced those, and they have really become best-in-class performers when it comes down to ESG.
We're talking with Ed Pierzak. He's Senior VP with research at Nareit about their 2023 outlook for the economy and commercial real estate and REITs. And, Ed, you mentioned that the REITs have pretty low leverage on their properties. How do REITs stack up on acquisition, a competitive acquisition market as folks try to make key acquisitions in 2023? Do they, have enough equity to come in and outperform private equity buyers?
Yeah, I think again, when we kind of break down the current environment, we really see that that current rates are a little bit of a challenge. And as I said before, they're kind of throttling the transaction market. But again, REITs are well positioned, certainly as anyone else, and in maybe some instances better to go forward with potential acquisitions. But again, the cost of debt, will likely play a role as they move forward with that.
Ed, what would you leave our audience with to think about related to this report and the year ahead of us?
Yeah, so I think that as we look out to 2023, I think that REITs are very well positioned to really take on any of the uncertainties. And if anything, if I had to pick a word to describe REITs going forward, it would be resilient. And lastly, for any of the listeners who are interested in our 2023 outlook, they could go to REIT.com and read a little bit more about it.
Perfect. Ed, thank you, sir. Thanks for being on the show.
Thank you. Have a great day.
All right, you too. And thank you for joining us around the country. Please let us know what you think. As you heard, you can read the report at Nareit's website. We'll also have a link to their website and the report at our website, CREshow.com. Well, until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. Appreciate the show? Consider referring business or doing business with our sponsors. Bull Realty is a commercial real estate sales, leasing, and advisory firm doing business throughout the Southeast, headquartered in Atlanta. Visit bullrealty.com for more information. Commercial Agent Success Strategies provides video training for commercial agents. This training gets 5-star reviews from even the most experienced brokers. Learn more at commercialagentsuccess.com. You're invited to connect with us on your favorite social media. You can find us on LinkedIn, Facebook, and Twitter. Don't miss a show of special interest to you. Be sure and subscribe to the show on YouTube and Apple Podcasts. And at the show website, CREshow.com, you can subscribe for a weekly email announcing the show topic and guest. While you're there, you also found more videos and podcasts. Thank you for watching or listening to America's Commercial Real Estate Show.